Mark Faber, publisher of the Gloom, Boom and Doom report, joins us from Thailand. Mark, good morning. Thank you for joining us. Mark, you've been quoted in the past and you've been pointing out to weakness in global equities for some time. But now that emerging markets have corrected, do you think it's time to revisit emerging market equities, or for that matter, global equities?
Well, I think we have to look at each emerging market separately, because we had widely diverging performances. We had since 2009 huge performances in the Philippines, Malaysia, Indonesia, Thailand, where these markets went up in the order of 3 to 4 times. And then you have markets like India that are still down in dollar terms by 50% from their highs, or Brazil that are down 50% from their highs in dollar terms, or Russia. And so each emerging market is in a different position. If you ask me specifically about the one or the other market, all I can say is, in my view, we had a huge correction in Indonesia and in Thailand from the recent highs. The market is down something like 30-35% from the April-May high. But following a rebound, I think we will see further weakness. Now, if you ask me about India, I suppose that Indian stocks, because of the currency weakness, have already experienced a very substantial bear market. It may last somewhat longer, but I think we're coming into a buying range.
Mark, geopolitical risk is increasing. How do you see this impacting crude and gold?
The impact, obviously, is interesting. I think the impact will be more severe on financial assets. The price of gold, as you know, has recovered already sharply from $1,180 to around $1,400. And I suppose that on hostilities, we will have some profit taking in gold. But I think we've made a major low at $1,180. And in the case of oil, the oil price has already been rising, but depending on the expansion of the hostilities, and don't forget, Assad is basically not a close ally, but he is aligned with Iran's policy. And so if he's attacked, Iran may perceive this as an attack on Iran, and they may counter-react. And then the hostilities could escalate, and that would mean that the price of oil could rise quite substantially.
But Mark, rising crude and weakening currency cannot be good news for India. Is India running out of options, or is there no easier way? Pain has to be borne.
India has pursued poor economic policies, and you can't really accuse the Reserve Bank of India specifically, but you have to look at the entire political elite, the entire system, and it has mismanaged basically the Indian economy for the last 50 years. And you cannot solve a crisis, the symptom of mismanagement that is now coming forward, in just 5 minutes or in a week. It will involve significant sacrifices, significant pain, and I doubt that in India there is the political will to face the music. And so they will continue to meddle through. The rupee's weakness is nothing new. When I went to India for the first time in the 1970s, in 1973, $1 still bought 7 rupee. And now it's close to 70. So it's nothing new. And the oil price increase, well, it's happened in the world, but of course it's magnified in India by the currency weakness. That's that's why I don't understand the mentality of central banks that print money in order to essentially lower the value of their currency, like they've done in Japan in the last 9 months, when in fact import prices then soar.
Mark, the debate is on whether the Indian rupee is undervalued or overvalued. Which camp are you following then?
Well, a currency doesn't go straight down forever, and there are rebounds. And how do you measure the value of a currency? Basically, currencies that have large trade, or countries that have large trade and current account deficits, tend to have a weakening currency. And on that score, obviously, India has a structural current account deficit, and so the currency is more likely to weaken in future than to strengthen. If you look at Mumbai property prices on the high end, then the rupee is probably not undervalued. If you look at maybe some assets in the countryside of India, and at some cost of living in the countryside, maybe the rupee is slightly undervalued. But it's a very difficult concept to say a currency is undervalued or overvalued. The best measure you can use is essentially the trade and current account, either surplus or deficit.
Right. So would you advise investors to put their money in gold and any other asset class you would advocate?
No, because we have to be aware that over longer periods of time, gold hasn't been a very good investment because it doesn't generate new businesses, it doesn't generate dividends, it doesn't generate cash flow and so forth. So in general, it's not been the best investment over, say, 100 or 200 years. I would suggest that some money ought to be in gold, namely as a replacement for having money on deposits with the banking system, because there's a risk on having money in the banking system. There is a risk on owning sovereign bonds and so forth and so on. So I would own some gold, and I accumulate every month some gold as a reserve.
Mark, finally, what's the outlook when it comes to Indian equities?
Well, as I explained to you, I would rather buy Indian equities than the S&P 500. But I said also, I don't think they will rally substantially in the near future. I think we may still go lower in sympathy with other markets in the world, because India is not an isolated market. If the S&P drops 100 or 200 points, India isn't likely to rally. It may outperform the S&P, but it's not likely to go up and the S&P goes down.
But Mark, really appreciate your time and thank you for joining us.